G'day and welcome to the Investor Motivation Podcast, number 2 for 2024. How are you, Amy?
Brilliant. How are you?
Going well, thank you. How good was the Australian Open?
Yeah, I didn't get to go see it live, but it's always good to watch, isn't it?
Just part of the summer, part of January, really cool thing to do.
Yeah.
What are we chatting about today?
Today we're going to talk about what we would personally do if we were brand new investors to start and we had $1,000, and then if that strategy would change if we had $5,000.
Right, yep.
And also if we had $50,000.
Fantastic.
So it's just, I think a great insight for what people think, we would do. And this is going to be personally with our money, but we'll also cover off things that we think people should be thinking about more broadly when investing for the first time.
Yeah, fantastic. And a lot of this stuff we see come out of the, a lot of the threads on Reddit and on the social platforms that, people are really interested to know where to start and what to do. And it's just a huge roadblock to make that start, to what do you invest into.
And it's fair enough because there's so many different, we always talk about the property spookers online that you should invest in this because you'll guarantee this return and the best investment you can ever make in your life. And then you see the crypto and it says the exact same thing. And then there's people talking about shares that say the exact same thing.
Yeah.
So how do you know what to do?
That's right. And then, share market is not just about investing. It's about day trading. It's about being in and out of the market. There's options, derivatives. It's too much. And it just clouds, I suppose, the thought process on which way we go and what do we do.
Yeah, and then there's too much to think about and too much to do, so I just won't do anything.
Yep, easy done. And excellent.
And then you miss out on those long-term graphs that we see that are awesome.
Yeah, and why do long-term graphs go up over time?
Because, for share businesses, share markets, because there are teams of people working behind each business, making that product or service better each and every year, driving up the value of that business.
Yep. And many of the people, and this is my personal experience, these are loaded questions, of course, Amy, you know that like...
I'm probably regurgitating what I've heard you say in the past as well.
Yeah, but like in our business, that each day we try to make things a little bit better, more efficient within the business, and better for our clients, better products, better services.
Yeah.
If we do that for long enough, which I've been doing for over 25 years, then there's every chance that things will get better.
Yeah, definitely.
We'll pick up more clients, we'll look after more people, more money, better outcomes, and therefore that improves the business.
Yep, profitability of the business and the value of it goes up with profitability generally.
Over time, correct. That's how it should go up.
That's how it should.
Excellent. I'll kick off with the acknowledgement of the land. On behalf of the Investor Motivation Podcast, I'd like to acknowledge the traditional custodians of the land on which we record this podcast and pay our respects to elders past, present and emerging. Beautiful. All right, where do we kick off?
Okay, so this is going to be personal. Mm-hmm. So not with the lens of what we would recommend to a client or a prospective client, but if we had $1,000 right now at our stages in life, how would we invest it?
Okay.
How would you go?
Okay. Now, keep in mind that this is general advice only. This is not personal advice that you should run off and do something with.
I like to say sometimes as well, do as I say, not as I do. Because we're experienced in the markets, we're probably a little bit more, I know when I say what mine is, it might not be definitely wouldn't be what I would tell someone else to do, but that's because we are very knowledgeable in the markets, and I'm willing sometimes to invest in something more risky, even if it fails. I'm just very interested in the share markets and interested in delving into businesses. So definitely none of this is recommendations.
Great. Well, let me start. We'll do the kickoff of the 1,000 first, and then give each our answer, then 5,000, and then 50. Because for me, the strategy will be slightly different for both. But ultimately, for assuming that these are, that we are new investors, we want the start of our investing career to be positive. So we've got to make sure that we don't blow it up and say, well, that was a really crappy, shitty experience in the share market. I will never go back there again. I'm also thinking in a world where previously when we do a trade on the stock exchange, it had to be a minimum of $500 plus brokerage. Now that's not the case. You can do transactions far less than that. So we've got a lot more flexibility because the technology is so much better. So for the $1,000 for me, And because I don't want to blow, just I suppose have that first time investing experience and just blow it up on an exploration resources company that's drilling for something, and they go from you cross your fingers and you hope and that you don't lose it all. But that's where people can lose it all.
Yeah, cross your fingers and hope you find something in that piece of ground you're digging out of.
Yeah. So for me, I would say 50 to 70% of that, $500 to $700, would go into an ETF.
Okay.
Now, for me, the ETF might be a smaller company ETF.
Yeah. So you maybe just explain what an ETF is for those that might not know.
So an ETF is an exchange traded fund. So it's on the stock exchange, but there will be a manager behind the ETF. It might be iShares or Vanguard. There's any number of these products out there. They come at a cost, but not a high cost. And that would be invested into a range, 20, 30, 40 different smaller companies.
Yeah.
The reason why I'm suggesting smaller companies is because if you go and buy, the ASX 200 or the ASX 50 in Australia, you get Australia's top 50. Yeah. And over long term, I think they'll give you a great result. They'll average over long term, a great result. But the smaller company stuff can provide you with, obviously, probably more volatility, a bit more risk, but more upside.
Yeah.
Then with the remaining $300-$400, I would go and select 3 to 4 companies.
Interesting.
Directly, because I think there's more knowledge to be gained by actually knowing what you own. And this might be Apple, it might be Microsoft, it might be Meta or Visa, whatever.
So do you think you would go international if you have the managed fund as the Aussie ETF?
Possibly, yes. Yep. Spread it around. Good to have both. But if you own some of these businesses directly, and I would relate it back to what are products that I use? Do I just love owning Peter Alexander pajamas and Ugg boots? Their answer is no to pajamas and yes to Ugg boots. I would like to own.
I don't want too much information.
I don't wear the Ugg boots to bed. Put it that way. So would I be happy to own Premier Investments? Particularly knowing that Solomon Lew and his family own a lot of that business.
Yeah.
There's a vested interest there.
And even though you don't want to wear all the things and buy all the smiggle and everything, that there are people out there that definitely do.
Absolutely. These are great businesses. They're expanding their business as they've always done over their whole lifetime.
Yeah.
So that gives you the ability to say, half-yearly reports in, the investor presentation, let's read what the managing director has to say.
Yeah.
And I think that's where, these are solid businesses. You don't have to go and play in that, specky, cross your fingers area. I've done a lot of money when I was younger in that space. So as I say to my clients, I've tried that, lost it, so you don't need to.
Yeah.
So go and find some great industrial businesses, 2 or 3. So, and then you can actually, read the investor reports, the CEO, the managing director's letters to their shareholders. So you get learning.
Yeah.
Yes. So, mix it up a bit. And today's technology, you can do it all off your phone.
Yeah, with very minimal brokerage. That's probably a good point when you are purchasing individual stocks with a small amount of money. If it used to be, some brokers were, $33 per trade. Buying 6 lots of businesses is quite a lot of money.
Yeah.
But
on a small amount. But now things have changed. We've got so much more flexibility.
Yeah, definitely.
Your turn.
All right. I'm probably, I did think if I was, young, well, not younger, but less knowledgeable about the market, that an ETF probably would be the way to go. And because I don't, some people don't have the time and effort to put into researching the businesses and reading the reports. But because we do that, and I do enjoy doing that, I think with my $1,000, I'd probably buy 2 businesses directly.
Right. Yep.
Because I would want to, delve into the business, read the story, follow the story, fall in love with the story, and have an actual, I feel like we obviously deal with a lot of money here, but buying $500 worth of a business, to me, it feels worthwhile. Mm-hmm. Sometimes I think purchasing, I don't know, you can do it now, but still purchasing $100 of a business, how much upside can you really have?
Yeah.
So that's just where my head goes.
Yeah.
Is
So less diversification, but potentially more upside.
more volatility.
And given what the markets have done over the last 12 months, which has gone up significantly, the Nasdaq's been up 36% for the last 12 months. And I haven't answered this question yet, but would you invest it all today?
My $1,000, not in international businesses because of that massive upswing we have had. But I think if I was to, really delve into some Aussie businesses that perhaps are still undervalued, of course, there's some stock selections that you can still do in the markets.
And how does a first-time investor know if something is undervalued or not?
I guess they're just going on the Yahoo Finance, aren't they, and trying to read as much as they can of. And that is the great thing about the internet. There are many resources available where analysts, full-time analysts, let you know what their recommendation is for a business, if it's buy, hold, sell, if they're underperforming. And you can do that, that lighter level research.
Yeah, and what Amy's referring to is she mentioned Yahoo Finance, so you can go and put in Visa, Meta, or whoever you like, and on the right-hand side there, it'll give you the analyst recommendations.
Yeah, and it will also give you the current share price, and then if it's undervalued, overvalued, what they think the fair value is of the company.
Yes, and for those that love really delving deeply, we use the paid version of Simply Wall Street, which has been, I use it in front of clients all the time so you can understand the debt, dividends, payout ratios, future growth, past growth, who owns it. So some good stuff. For me, with $1,000, I would just invest. I would just go now.
Not delve in too deeply?
No. Obviously, with bigger amounts of money, I'd think more deeply about spreading out the investment. All right. Excellent.
$5,000. So 5 of those 1,000s, would you just do 5 different things of the same thing or change completely?
Well, no, there would still be an ETF in there and involved, because I'm just, I've seen it where the timing's been wrong for a first-time investor, and they haven't had a good front-end experience, and when that happens, I think, well, that's a dog place to invest. I'm never going back. And I just wouldn't like people to be burnt by being too pointed, chasing high returns.
It sounds a little bit like you're talking about for a brand new investor that doesn't know much about the markets, but if you personally right now had $5,000, would you still be buying an ETF? And if you didn't have an investment portfolio of your own?
No, I'd probably be, personally, I'd want some diversification there. And it might be $1,200 into 5 direct businesses that I'm comfortable with. I would probably invest, 2 or 3 now, buy them now. Ones that perhaps haven't ran as hard. Because when you have a look at Microsoft and Visa and, Meta over last night was up substantially. A lot of these businesses have done 100 to 200% in the last 12, 18 months. Huge jumps. It's very hard to purchase them. I'd like to see people a little bit more scared. But for those people that have $5,000 and are new, they want to do something. Patience. People are not patient when it comes to investing.
Not at all, especially when you have seen that hockey stick growth of a share price and you go, oh man, I need to get on that bandwagon, and you just go in at the top of the hockey stick and then bam, potentially.
Well, I just got off the phone from a very long-term client, lovely chap. And when the market goes down, I have to nurse him through. He doesn't learn much from one conversation to the next. And I've always got him to hold, and it's always turned out fine. Now, this time we rang him and said, oh, gee, Rob, all this money in cash. Now, we're paying out pensions. He needs some cash. He said, is that all right there? And I said, well, what would you do with it? He goes, I'll put it in the share market because it's just done well. And I said, mate, I'd prefer you be on the sell side than the buy side now. But that just shows investor psychology is alive and well.
Definitely.
So more direct exposure because there's just a little bit more to play with. But ETFs are completely fine as well. And regular investment as well.
Yes.
Cool.
Cool.
$5,000. Amos, you're in.
Okay, so with the 1,000, I was going 2 direct Aussie shares. $5,000, I think I'm going to go $1,000 now into an international ETF. So that will get my international exposure and diversify geographically. And then the $4,000, I'd probably stick to my $500 and go 8 Aussie companies.
Great. So direct companies.
Yep.
Fantastic.
Again, do my research, and especially with one of my favorite things to look at with any company is the ownership and making sure they have a big piece of the pie.
Yes.
Because then, same as we do here, we run the business efficiently and profitably, and I know that they're doing the exact same thing for their families and themselves. And
fantastic.
that's
Very
definitely
good.
a good one.
And for those people that don't want to then go and research and find Premier Investments or Washington Soul Patterson, all these different amazing businesses, and you just want diversification and somewhere to put some money, the ETFs, exchange traded funds, are fine. They're diversified. Yes. You can get pointed. They're very niche-y as well. There are so many products out there.
Yeah.
That is nothing wrong with that as well.
Yeah, you see less volatility, so there's less fear mongering and worry when it comes to it. It's just a bit more of nothing's ever a set and forget, but with that, it's being professionally managed behind the scenes for you.
Yep. Now, $50,000. That's a different kettle of fish altogether, isn't it?
Yeah, I don't even know how to answer this because I have never had that happen to me yet.
Okay, I have done a bit in terms of investing. And for me, again, just where the market's at the moment, I'd be very selective on, I would not invest $50,000 now, today, all at once.
Yeah.
No chance.
So if you won the lotto when you got $50,000, you'd hold on to it for the time being?
Yes, I would. Yep, I would. I would be preparing. Again, this is in first-time investor mode that, $20,000 of it might go into a smaller company's ETF or, an international ETF, mix it up. Again, diversification is good. And then go and select some great businesses.
Yeah.
But let's say I put $25,000 into ETF. I could do that, $5,000 every 3 months.
Yeah, okay.
And just have a routine where that just happens, and regardless of where the market's at.
Yeah.
With the ability to say, well, gee, it just went up another 10%. It's, the market is people are getting too greedy.
Yeah.
And I need to back off.
Yeah. So vice versa, is there a percentage drop that would make you go, okay, I'm going to go all in now, or you would stay progressive incremental 5?
Cool. Let's say you have a correction 10% plus.
Mm-hmm.
The market, if the market has just gone up, say international shares for many of our client portfolios have been up by well in excess of 30%.
Yeah.
A correction of 10% gets you a little bit excited. So at $50,000, you might do 5.
Yeah.
But that's just a correction. And of course, if it goes down 10%, can it go down another 10%? Of course it can.
Of course it can.
20% from the top. Then you probably get a little bit more excited.
Yeah.
And then if it's a full-blown crash, like I've seen during the tech wreck, like I've seen during the GFC and COVID, where the markets globally are down 30 to 40%, and the news is horrific, I'd go all in.
Yeah.
I'd be watching like a hawk, reading every little bit that I could read about what Warren Buffett is doing.
Yeah.
But you only find out in hindsight that he was pinning his ears back because they're sitting on over $150 billion in cash.
Yeah.
He wouldn't be doing a huge amount of buying now.
No.
Yeah. So that's what I'll be doing. And as always, I am a direct share lover. ETFs don't form big parts of my client portfolios or my own. The reason why I've included it here is because of that first-time investor experience. I don't want it to blow up and then they go, well, what an ordinary place to invest. Yeah. I'm never going back there again.
Yeah. And you would be going with that $50,000 when it's eventually all invested, it would be into direct shares, all of it?
No, I would still go ETF because in my mind it's still partly it's a first-time investor. I'm brand new. I don't want a horrific experience in the first 2 or 3 years.
Yeah.
And then we've seen this, where people are like the client I just mentioned. The markets just went up wonderfully. His portfolio as a whole probably returned him 20%.
Yeah.
Happy days. Now he wants to invest more.
Yeah.
And I essentially said, no, now's not the time because I know I'll need to nurse him through the downtimes.
Yeah.
Yeah. So, we all talk about long term, but it's our initial experience will dictate how we feel about it.
Yeah.
It'll be that first 2 or 3 years. And when in the short term, when you buy actually matters.
Yeah, it does.
Yeah.
If you're buying now after this massive upswing, and there's generally and historically a correction after that, it does matter that you purchased it at that high. And
and you're gonna check on your portfolio on a daily basis because it's on the app on your phone, which I wouldn't recommend you do, but people will.
Yeah,
of course you will.
Yeah.
Yeah, I'd be interested. I've done that my whole life.
Yeah.
Yeah, I don't look at my portfolio anymore on a daily basis.
Oh, yeah.
But when I was buying, when I was younger, of course I did. I loved it. I still love it, but I spend now I don't sort of barrack for share prices.
Mm-hmm.
I just read reports.
Yeah, make sure the business is still doing exactly what it should be, and that's end of story, really, isn't it?
Is there progress? I own Meta, which was Facebook, and I did a quick TikTok video on that just before.
Mm-hmm.
Understand what happened. They've reduced their headcount, 22% reduction in employees, and they had 24% increase ad revenue. Fantastic.
Wow. Cut expenses, boost profit.
But profit's gone up, paying their first dividend, doing a $50 billion share buyback over the next X amount of years. Big thumbs up. Happy days. Give me more of that. Yeah.
Brilliant.
So I don't need to focus on what happens to the share price on a daily basis.
Yeah.
So I know Zuckerberg and friends are working really hard.
Yeah.
These are smart people, smarter than me people in their field.
Yeah.
Yeah.
And do you think with the $50,000, like when or would you ever go looking at a more speculative share?
Okay.
If you had a lot of money, would you set aside a little bit that you're like, oh, okay, I'm happy to lose 10%. A little bit?
Yeah. $5,000 goes into these two. My mate's dad said this company is found something next to the Pilbara or something exciting like that. Well, go for it.
Yeah.
I don't know what the stats are, but 1 in every 200 of those exploration companies might shoot the lights out. I've seen one particular client I can think of came in and said, Sedeco was the name. It was a copper explorer.
Yeah.
This is 20 years ago. I can't remember the numbers, but it was thousands of percent.
Yeah.
It was just that
growth,
just that luck.
Yeah.
And it happened within a year and a half. Just sheer luck.
Yeah.
They found something they didn't know was there.
Yeah.
They were hoping it was there. Yeah. Oh, yeah. $50,000, Amy, off you go.
$50,000. Personally, again, not what I would. Don't do as I say. Sorry, do as I say, not as I do.
Good.
I would probably 10% allocate to smaller businesses. So small market caps and that are more risky, and maybe even in the climate change space. We know there's going to be $50 trillion invested into climate change in the next till 2030. So I'd probably try and find some businesses that are going to have some of that tailwind behind them.
So look at some themes that you're a believer in.
Yep. And because those are such new businesses and there's so many of them trying to innovate and be the one that changes the world, that's where the risk and the speculation comes into that. And then for the other 40,000, probably just keep sticking to my direct shares, but I'd probably up the amount from the 500 in each company to maybe $2,000 and $3,000 lots.
Great. So diversification is still important.
Yes.
Yep.
And I probably actually wouldn't go an international ETF with 50,000. I would go direct international.
Fantastic. So,
stock selection across the board, and then a little bit of speculative stock selection as well.
Would you spend or invest? Spend's the wrong word. Would you invest the $50,000 altogether, or would you try to space it out?
Not at this current point in time. I wouldn't because of that upswing that we've had, and it does feel very greedy right now.
So let me paint a hypothetical for you, Amy, where we are actually down 30% right now, and you've got your $50,000, and in a way you're thinking, right, 30% down, but geez, Rob, how much further could it go down? Because this is what people ask. Could I lose all of my money? What would you say, if at 30% down, would you be waiting, oh, geez, well, all the news is so bad, it's going to go down further, I'm going to wait?
Absolutely not.
You wouldn't?
No.
Would you petition? Would you do a bit now and then go again, or you just 30% down is enough for me?
I think 30% down is enough for me.
Yep, you'd be
unless the upswing of the previous 12 months was like 60%.
Yep.
That's huge. Then 30% down, I would think, oh, okay, this is probably now fair value. It's not cheap.
Yep.
It's probably just corrected to where it should be.
Yes.
So it does matter what has happened in the previous 12 months probably. But if it was, and this is hindsight bias again, but my first investment was during COVID. COVID hit, everything was down 37%, that 27%.
So you've done it in practice.
Yeah. And then I just thought,
well done.
If I had more money, then I would have put more in.
Yeah.
But I didn't. So I just did what I had, and it was brilliant.
Right.
So
and what happens in practice, just for our listeners, that in those times people are thinking about, well, Rob, do you think it'll go down further? That's the question I always get. And I quite honestly say, I don't know.
Yeah.
But if it does, we have this here to go again.
Yeah.
Yeah. So it's no one knows what's going to happen in the short term. It's just when everyone's feeling as emotional and as scared as possible. What Warren Buffett. When there's blood on the streets and when people are fearful, that's when Buffett gets greedy.
Yeah.
Yeah.
And it's important to, if there was a 30% dip in the market now, actually understanding why that has happened. So with COVID, it was global pandemic.
Yeah.
But have a common sense lens on that and think, okay, well, some businesses, yes, will be, affected in the short term negatively, but some businesses won't be affected at all, and their share price has copped that 30% down.
Yep.
So it's understanding which sector to be in that shouldn't technically be valued as it is, because nothing fundamentally has changed to that business. So it's just making sure you are still keeping a common sense lens on why things have happened and is it reasonable. If not, go in and
fantastic
reap the rewards.
All right, Amos. I reckon that is an awesome discussion. Glad we did that one.
Yeah.
Do you think
we covered off enough on what first-time investors should think about? Well, it's definitely don't go too hard too fast.
At this stage,
stage, yes.
Because of where the market's at, and this is 2nd of Feb 2024, I think what you do need, volatility.
Just know that it's there. And
well, I suppose why are share markets so volatile?
Yeah.
They're so volatile because share markets are liquid. There's liquidity. So every trading day, which is probably 75% of the year, a day that you can trade in and out. So that volatility, that liquidity means that people, if they get scared, they can sell that day. If they get greedy, they can buy that day.
Yep.
So that liquidity will be dictated by the emotions, the fear, the greed, the calamities around the world.
Yeah.
So the short term will be dictated by that because share markets are so liquid. A tap of the phone, a click of the mouse, we can buy, we can sell.
Yeah.
And so, markets are scared, they'll go down quickly. If the market is greedy, it'll go up quickly because of, it's an emotionally driven thing. But what dictates the results in the long term is the businesses doing what they do.
Yeah.
So I think that is just, that investor psychology, which I talk a lot about to my clients, preparing them for it.
Yeah.
And it's amazing. We can prepare them for it, tell them about it and show the graphs. But until they get there and they see their money, go down, all the theory just didn't seem to count for too much.
No, the emotions take over and it's, purely emotional.
Yeah. So if things go down and you see your portfolio of $100,000, $5,000 or $50,000 goes down, I'd recommend not look.
Yeah.
I know it seems silly, but just let the businesses do what they do. Take a long-term view, and you will be in the best asset class over your lifetime.
Yeah, and if you have to look, and you do see something negative happen, go straight to that company's investor center, read an announcement.
Yep.
What has happened? Understand it. Not just see a price, see the red, and freak out.
Yeah, and hopefully, whether it's 1,000, 5,000, or 50,000, that it's money that's been saved. And you've got more money. And if it's down, guess what? It just got cheaper.
Yeah.
Go again.
Yeah.
Yeah.
Make sure you still believe in what the company's doing and then
go again.
Yeah.
Yeah. So that's probably the main thing for me. Yeah, understanding that volatile is completely normal, but it makes people feel really ordinary.
It does.
Yeah.
All right. I think
Excellent.
that's probably enough for today. And
Awesome.
if people are wanting to invest for the first time and wonder what we do look at when we're looking at individual direct share stock selection, we have done a podcast on that before. So make sure you go check that one out.
Awesome. Check out our YouTube channel. There's now over 600 videos that we've done over the last 12 or 13 years. Amy's Wealth Diaries is on Instagram. I've just kicked off my TikTok, which is good
Rob
fun
Gowdy?
experiment thing to do at Rob Gowdy something.
Hopefully,
Yeah.
we think it's a TikTok algorithm that you have to have a certain amount of followers before you can do live podcasts. But once we get that amount of followers, we'll definitely live stream these podcasts as well and be open to live Q&A. But until then, leave a comment with any questions that you want us to cover off, and we will definitely do that.
Awesome. Thanks for listening. Cheers.
Bye.
Bye.